Welcome back. You've made it to this lesson, derivatives markets. Now, a derivative is something that derives its value from something else. In financial terms, we mean a contract between two parties that derives its value from an underlying asset or multiple assets. It's very important to know a thing or two about derivatives. We are going to be trading derivatives as well, and I will show you an example in a second. But just remember for now that the derivatives market is one of the biggest markets out there, and it is said that it is a size of about $1 quadrillion US, which is a 1 with 15 zeros. Yeah, it's enormous. Let's take a closer look. So thank you Investopedia here for noting this good definition. I couldn't have put it better myself. A derivative is a financial security with a value that is derived from an underlying asset or group of assets. The derivative itself is a contract between two or more parties, and the derivative derives its price from fluctuations in the underlying asset. Now, if you take a brief look at the picture that I've included, this is something that a derivative could derive its value from. So it could be stocks, could be bonds, and it could be commodities or currencies perhaps. There are three main types that I would like to discuss in this video, but again, this is introductory. You need to do some research yourself on each of the three types. Because if I discuss each of the three types in this video, this is going to be an hour long. There are so many different derivatives out there, but they are all within the category of these three. So first of all, we have the future. I briefly mentioned that in the previous lesson, but a future is a financial contract that obligates the buyer to purchase an asset or the seller to sell an asset and have a predetermined future date and price. Next up, we have the option. The option gives a buyer the right, but not the obligation, to buy or sell the underlying stock or asset at a preset price called the strike price. In chapter 4, when we are going to really talk about practical trading, we're going to do a couple of lessons on options. It's a very, very important instrument, and it's also very popular. So we will dive deeper in chapter 4. Last but not least, the swap. This one is a little bit more complex, and it's not something you get in touch with as a retail trader very soon. But yeah, do some research on what a swap is. And if you know, for example, the film The Big Short, in that film they discuss the credit default swap. So I encourage you to do your own research there and look up what a credit default swap is. But let's just briefly discuss the definition. A financial swap is a derivative contract where one party exchanges or swaps the cash flows or value of one asset for another. For example, a company paying a variable rate of interest may swap its interest payments with another company that will then pay the first company a fixed rate. And here you can see that you can use swaps, for example, to manage your risk. Like you can imagine that a fixed rate, a fixed interest rate that you are going to pay or that you are being paid is a little bit more stable and gives you more security than a variable rate, a rate that fluctuates. So I just want to show you a quick practical example. And we are going to be using the FTX cryptocurrency exchange for our trading later in the course. And actually, it is a derivatives exchange. So there you see it. You're already getting in touch with derivatives. Now, they have something interesting. I opened this session by saying that a derivative is something that derives its value from something else. And the FTX cryptocurrency exchange has introduced something very exciting, a way for you to anticipate and make money on the presidential elections of 2020. So in this article, they mention this, and you will see that the product that they've created is actually a future. So that's one of the three categories of derivatives. Scroll down a little bit, and here it says that the crypto derivatives exchange FTX recently launched Trump, a new futures trading product that lets users bet on President Trump's re-election in 2020. So what does this look like? Well, let's just quickly hop on to the FTX exchange. And here you see it once again, FTX is a cryptocurrency derivatives exchange. Look at the top and there you have it, the President 2020. You can select this product. Let's just select Trump to make it easy. Say that you you are confident that Trump is going to be re-elected. Well, you can place your bets here. You can speculate on that. So in this chart, you can see on the right that this the price currently is 40 cents for this contract. That means that buyers and sellers agreed upon this price right now, and it says that Trump has a 40% chance of being re-elected. So we can check that with other presidential candidates, for example. Let's say Elizabeth Warren. She, of course, resigned. She's not running anymore. And here the contract has a value of almost 0. And the same goes for the other presidents, the candidates that dropped out. Biden right now, however, the Biden contract has a price of almost 58 cents. So buyers and sellers are now saying, okay, well, there's a 58% chance, according to us, that Biden is going to be president. Back to the article, you can see here that they described it pretty well. Trump's value at any given, so that's the Trump contract, which is now sitting at, what was it, 40 something cents. Let's go back. Yeah, around 40 cents, 40.5 cents. Trump's value at any given moment can be understood as an expression of how likely the traders think he is to win at any given moment. So when Trump is worth 50 cents, users are effectively saying that Donald's victory is a 50-50 shot. Another important thing to note here is that the Trump crypto product is merely a futures contract that is worth $1 if Trump wins the 2020 presidential election and 0 if he does not. So I hope that gives you a bit of a picture of what a derivative is and how they are being used. And I mentioned that the derivatives market is very big, and of course this is so because there is one presidential election, but there can be countless of contracts written up between two parties. So if you measure the value of all those contracts combined, well, then you get this ginormous number of perhaps over a quadrillion. Who knows? Gigantic. That's it for this lesson. I think I've given you a good overview. If not, ask your questions in Slack. Correct me if I'm wrong in some part. But I will see you in the next video, Money Markets.